Are you curious about the future of the global economy? Have you heard the latest news that the BRICS nations are set to surpass the G7 nations for economic growth in 2023? What does this mean for you as an investor or for your financial future? Should you be worried or excited about this shift in the balance of economic power? Join us as we delve into this topic and explore the opportunities and challenges ahead. It seems that the emerging markets, led by Russia, Brazil, China, India, and South Africa, are set to surpass the G7 nations in terms of economic growth in 2023. According to the latest IMF data, the BRICS countries, Brazil, Russia, India, China, and South Africa, are expected to contribute 32.1% of the world's growth, surpassing the G7 countries' contribution of 29%. What's even more impressive is that this is happening despite Russia being the most sanctioned country in world history and China, Brazil, and India facing intense Western pressure. The shift towards emerging economies is not a recent phenomenon. For the past few decades, emerging economies have been growing at a faster pace than developed economies. In the last few years in particular, the gap between the growth rates of emerging and developed economies has widened further as emerging economies have shown greater resilience to global economic challenges, such as the financial crisis of 2008 and the COVID-19 pandemic. Russia, Brazil, China, India, and South Africa, commonly referred to as the BRICS nations, have emerged as major players in the global economy. The BRICS countries account for over 40% of the world's population and about a quarter of global GDP. The growth of these economies has been fueled by various factors such as urbanization, rising incomes, increased consumer spending, and favorable demographics. Despite facing various challenges, the BRICS nations have been able to maintain their growth momentum. Russia, for example, has faced several rounds of sanctions from the West, which have had a significant impact on its economy. However, the country has managed to weather the storm and is expected to continue to grow in the coming years. Similarly, China, Brazil, and India have faced pressure from the West on issues such as trade, investment, and human rights, but they have managed to maintain their growth momentum. Let's take a closer look at this Bloomberg piece that shows how the group of 7 G7 nations, the United States, the United Kingdom, Canada, France, Germany, Italy, and Japan, have long been considered the most advanced economic bloc of countries on the planet. But now, the BRICS nations are on the rise, and it's time to pay attention to where the puck is going. It's a world-shifting moment, and it's happening right now in 2023. We have the opportunity to witness the decline of Western hegemony and the rise of a new multipolar order. This is a teachable moment for our families and for our kids to understand the changing power dynamics in the world and how it will affect our future. The global power shift is undeniable. The BRICS nations, led by Russia, Brazil, China, India, and South Africa, are predicted to surpass the G7 countries in economic growth by 2023. Despite being the most sanctioned country in world history, Russia is still managing to outperform Western governments, and Brazil, South Africa, and India are also making significant strides. Even more surprising is that India has now surpassed China as the world's most populous country. By 2028, the G7's contribution to the world economy is expected to decrease to 27.8%, while the BRICS countries will account for 35%. In fact, 75% of global growth is expected to come from just 20 countries, with over half coming from China, India, the United States, and Indonesia. According to the IMF, by 2028, the top 5 contributors to global economic growth are expected to be China, the United States, India, Indonesia, and Turkey. These countries are projected to account for almost 50% of global growth in the next 5 years. Furthermore, the rise of emerging markets is not just limited to the BRICS countries. Countries such as Mexico, Nigeria, Vietnam, and the Philippines are also expected to make significant contributions to global growth. In fact, it's estimated that the global middle class will double to around 5 billion people by 2030, with the majority of that growth coming from emerging markets. This presents a massive opportunity for businesses and investors looking to tap into these growing markets. In the latest news, it appears that the BRICS group is gaining even more interest from countries outside of its core membership. Saudi Arabia has expressed interest in joining, and Mexico is also looking to become a member. This could have significant implications for the global power structure, particularly as the oil flows to China increase. It's important to stay informed about these changes and think differently about how we invest our money and what protections we have in place. The era of Western dominance is waning, and it's up to us to adapt to the new realities of the changing global order. If you reside in Western countries and your family's financial security is tied to the euro or US dollar, it's crucial to rethink your investment strategies. The shifting global power dynamics necessitate a new approach to safeguarding your family's future. Additionally, it's vital to consider travel options and protection measures beyond just obtaining a U.S. passport. By expanding your perspective and exploring alternatives, you can prepare yourself and your family for the changing times ahead. According to Andrew Henderson, a nomad capitalist mindset suggests that one should go where they are treated best as a human being. It's important to consider having access to multiple citizenships and multiple ports of call to make the most sense for your business investments. It's crucial to keep in mind that the United States isn't the only option out there, and it's worth exploring alternative avenues to secure a prosperous future. The Bank of England has warned that cash will become less convenient as shoppers increasingly turn to online and contactless payments, causing high street stores to reject banknotes and coins. Sir John Cunliffe, Deputy Governor of the Bank of England, predicts that it will become harder to spend physical money in the coming years due to the rise of digital transactions. While some argue that we should boycott online shopping to prevent the shift towards a cashless society, many people find the convenience of online shopping hard to give up. In fact, 85% of payments in 2021 were made electronically, and this trend is likely to continue. However, this poses a concern for those who want tangible assets like gold or silver to protect their families, as it may become more difficult to take out large amounts of cash for transactions. Some are even questioning the legality of businesses refusing to accept legal tender in the form of physical cash. Despite these concerns, the move towards a cashless society seems inevitable. Now, this news can be viewed in two ways. You can either look at it as doom and gloom, thinking that the G7 nations are losing their grip on the global economy, or you can look at it as a positive development, especially if you're an investor looking to put your money in the right place for the future. So, what does this mean for you as an investor? Well, it's an excellent opportunity to get behind the right horses for the future. By analyzing the potential growth prospects of these emerging economies, you can make informed decisions about where to invest your money. This news about the G7 nations losing their grip on the global economy can be viewed as an opportunity for investors to explore emerging markets and invest in their growth potential. As the world economy shifts towards emerging markets, it presents an excellent opportunity for investors to put their money in the right place for the future. These emerging economies are characterized by a rapidly expanding middle class, rising incomes, and increasing demand for goods and services. This presents a promising opportunity for investors to capitalize on these growth trends and potentially earn significant returns on their investments. In addition, emerging markets also offer diversification benefits for investors. As the economies of the developed nations become increasingly interconnected, investing solely in these markets can be risky. By diversifying into emerging markets, investors can reduce their overall portfolio risk and potentially benefit from the growth prospects of these markets. Investors looking to capitalize on this trend can consider investing in companies and sectors that are likely to benefit from the growth of emerging economies. For example, companies that are involved in infrastructure development, consumer goods, and technology could be well positioned to benefit from the growth of these economies. Investing in mutual funds and exchange-traded funds, ETFs, that have exposure to emerging markets could also be a good option for investors looking to diversify their portfolios. Overall, the news about the G7 nations losing their grip on the global economy should be viewed as a positive development for investors who are willing to explore and invest in emerging markets. By carefully analyzing the growth prospects of these markets and investing in the right companies, investors can potentially benefit from the significant growth potential that these markets offer. So there you have it. Be sure to leave a comment, and before you leave, why not like and subscribe? See you next time.